We're going to get started. Hello, everyone. I'd like to welcome you to this American Finance Association panel called The Pension Crisis, Public and Private. The field of finance, I believe, has much to say and also much more research to do on the increasing financial challenges that governments and households face in attempting to provide resources for retirement. The main goal of the panel today is to highlight some of the research topics and policy issues related to these challenges. I'm hoping we'll be able to discuss the conclusions of the research, the extent to which it has or has not delivered clear and actionable policy recommendations, and we'll also highlight some areas where more research is needed. Let me now introduce the panel of esteemed experts with whom I have the pleasure of sharing the stage. First, John Chauvin is the Wallace R. Hawley Director of the Stanford Institute for Economic Policy Research and the Charles R. Schwab Professor of Economics at Stanford. He's also a Senior Fellow at the Hoover Institution and a Research Associate at the NBER. He specializes in public finance and corporate finance and has published more than 100 articles and 20 books on Social Security, health economics, taxation, pensions, and related topics. Next to him, to his right, is Jeffrey Brown. Jeff is the William Carnes Professor of Finance in the College of Business at the University of Illinois Urbana-Champaign and a Research Associate of the NBER. He has served as a senior economist at the White House Council of Economic Advisors. He was on the staff of the President's Commission to Strengthen Social Security, as well as the Social Security Advisory Board. In the interest of disclosure, Jeff wanted me to note that he is a trustee for TIAA-CREF, since annuities is one of the topics we'll probably end up touching on today. Jeff has published extensive research on insurance markets, Social Security, pensions, and annuities. At the end of the table is Stephen Zeldis. He's the Benjamin Rosen Professor of Finance and Economics at Columbia Business School and a Research Associate at the NBER. His extensive research has examined a wide range of applied issues in macroeconomics and finance, including Social Security reform, the determinants of household saving, participant behavior in pension plans, and the measurement of pension liabilities. Lastly, I'm Josh Rao. I'm a professor of finance at the Stanford Graduate School of Business, a senior fellow at the Hoover Institution at Stanford, and a research associate at the NBER. I specialize in corporate finance as well as the financial structure of pension funds and their sponsors and the measurement of pension liabilities. Now, it's a bit provocative to use the word crisis in the title of a session, so to get the session started, I'd like to briefly lay out some of the areas where this term might arguably be considered appropriate, where we could at least have a discussion about whether it's appropriate, and use that as a bit of a roadmap for the session. So first, and perhaps closest to the focus of my own research, are the unfunded retirement promises of state and local governments to their current and retired employees. These debts have become quite large. Under governmental accounting, there is around $750 billion of unfunded pension liabilities. Of course, government accounting uses expected returns on assets to measure liabilities. This is something that in finance we try to teach our students not to do. So when you revalue accrued promises as government bonds, one finds unfunded pension liabilities on the order of $4.5 trillion. Secondly, there remain many private sector sponsors of defined benefit pension plans. For example, 30 of the Fortune 100 firms still sponsor a pension plan. Firms have faced a very difficult environment for pension funding and have been trying to change their plans through freezes, conversions, and other actions. But there are questions about whose interests these actions best serve. The federal government insures corporate pensions of bankrupt firms through the Pension Benefit Guaranty Corporation, an arm of the federal government, and the fiscal liabilities of this entity, the PBGC, have likely been exacerbated through recent legislation. Third, the main national system for retirement security, Social Security, also faces financial imbalances, and its structure may contain incentives that distort individual behavior. Fourth, the readiness of private households for retirement has been questioned, particularly as pertains to whether the 401k model has led to sufficient accumulation of assets for households. Individuals are increasingly responsible for managing their own retirement through 401ks and other defined contribution plans and individual savings vehicles. And finally, the private market for annuities remains, from the perspective of many economists, underutilized. This is even as more and more people are arriving at retirement with account balances as opposed to pre-annuitized wealth outside of Social Security. So I hope that this enumeration of issues highlights that the crisis in many ways is two sides of a single coin. On the one side, there is retirement income security individuals' ability not to outlive their savings, to be able to provide for an adequate retirement for themselves. And on the other side is the issue of the governments or the sponsors trying to provide pensions and trying to do so without causing a financial crisis. So there seems to be a fundamental tension between retirement income security on the one hand and government solvency on the other. So with that introduction, I'd like to invite the panelists to each make some comments for around 10 minutes each, and then we will have a discussion about some of the issues, and then we'll be opening it up to the floor. So with that, I'll turn it over to John.
So I'm going to talk mostly about demographics. And for most people in the audience, your life expectancy is somewhere in the 80s. On the other hand, say I was to ask, how long until the longest live person in here dies? The last to die in this audience. It'd be well over 100. So much higher than your life expectancies. That's because we're a big group, and the last to die would be maybe in the 1 percentile of luck, and they'd last more than 100. Well, the limit of a group is 2. Couples are a group. And so a couple, when they're thinking about their retirement, they have to ask, well, who's the last to die? How long until the second death in the couple? And that exceeds the life expectancy of either member of the couple. So just how long is it? What's the life expectancy of a couple who is retiring at the average retirement ages today? So the average retirement ages today for men is about 64. The mode is 62, but the average is 64. For women, it's 62. So say you had a couple that was 64 and 62 and they retire. And you ask, well, how long in expected terms until they're both dead? The answer is 27 and a half years. That's a pretty long time. Now, let's say they weren't average lucky, they were 90th percentile lucky. They were luckier than average, not incredibly lucky, but 90th percentile lucky. 35 years of retirement. 27 and a half on average, 35 years if you're in the 90th percentile for couples. Now, how long could this couple, retiring at 64 and 62, how long could they have worked? Well, I suppose they could have worked for 45, but 40 strikes me as probably a more reasonable guess of how long they worked. So the question is, with a 40-year career, can you afford a 27-and-a-half-year retirement? Or for that matter, a 35-year retirement? If you don't annuitize, you have to be prepared for the 90th percentile outcome. If you do annuitize, the annuity company knows about adverse selection, and they're going to price it as if you're going to live 30 years. So the real question is, can you finance a 30-year retirement with a 40-year career? And my answer is no. And this is before we've talked about unfunded intergenerational loan programs like Social Security, defined benefit, defined contribution, discount rates, illiquid assets, whatever else you want to talk about. It just can't be done. You can't finance 30-year retirements with 40-year careers. So my view is we just have to adjust adult lifetime and move towards 50-year careers with 20-year retirements. That's, maybe the arithmetic can work. But I honestly think that in the next 40 or 50 years, the common age of retirement is going to be 70, not 62 or 64, and I think it's inevitable. Now, if you think we have to work longer, then you want to look at policies that we currently have in place to see whether we're encouraging short careers or long careers. Well, it turns out when you look at them carefully, we're encouraging short careers. For instance, look at Social Security. It only counts 35 years of work. The modal age where men achieve 35 years of covered experience is 52. After that, Social Security gradually, not necessarily instantly, but gradually becomes essentially a pure tax on work. You work more, your benefits don't go up, you pay taxes, 15.3%. Medicare has always been a tax on work. You don't get more Medicare if you work longer once you're eligible. So that strikes me as, when you work for the first 35 years, you're earning some extra retirement benefits, but when you work beyond that, you're not. Now, there's a little bit of exaggeration there. Maybe the 36th and 37th year knock out some other years in the calculation. By the time you get to 40, it's probably just a pure tax on work. So I have proposed with co-authors, several co-authors, Sita Slavov, Gopi Shah Goda, and George P. Schultz. You probably heard of the last guy. A new policy which we call paid up, which is after 40 years of covered employment and making payments to Social Security and Medicare, you're paid up. No more payroll tax for you or your employer. So if you want to work that 41st year, you would get much closer to the value of your marginal product for working for that 41st year because there would be no payroll tax. Second policy that discourages work is the way Medicare works. And I must admit, I only discovered this 3 or 4 years ago. But I thought when you got 65 and you'd work for 10 years, you got Medicare when you're 65. Well, that's true, unless you work for an employer who has a health care plan and 20 or more employees, in which case you don't get Medicare. Basically, Medicare says, hey, you and your employer can take care of your health care. They call it Medicare as a secondary payer, but basically Medicare stands back. So here's the deal. If you work, you pay for your health insurance. If you don't, we'll give it to you. Well, that's a big tax on work. So if we're trying to get people to work longer, we've got to get rid of these policies. For instance, a policy you could have is Medicare as a primary payer. Say you're 65 and you're eligible for Medicare, and you go to your employer and say, hey, you don't have to take care of my major medical because I got Medicare. Suddenly, employing you is a lot more attractive. You'll get a higher wage. By the way, 65-year-olds are pretty responsive to wages. Much, much more responsive than 45-year-olds are to wages. So you could get a big supply response if we made it more lucrative to work for long careers. But we actually favor short careers. I'll give you one last example, and then hopefully I'll end with a surplus in time. But the way Social Security works, it's not only that they count 35 years, but they count the first ones more than the later ones. For instance, say you had 2 people with the same wages. One worked for 17 and a half years and the other worked for 35. Okay? One worked twice as long as the other, contributed twice as much. Do they get twice the benefits? No. About 50% more, but not twice. And that's because the way Social Security works is they want to be progressive in terms of let's give low-income people a good deal, but they get confused and they think short-career people are low-income people. That would be easy to fix. So we've got a bunch of policies which strike me as similar to Europe. Sort of lump of labor, get those old guys out of the workforce so the young people can get jobs. I think we've got to reverse those policies and at least become neutral with career length and maybe even encourage long careers. Otherwise, we're stuck in the current situation, which is trying to do the impossible. And just to circle back, the impossible is financing 30-year retirements with 40-year careers. It just won't work.
Okay, thanks very much, John. With that, we'll turn it over to Jeff Brown.
Well, good afternoon. And first, let me thank the AFA for sponsoring the session and Josh for organizing it. And I'll also just say that if you're looking for controversy, I'll just start by saying I endorse everything that Josh and John have said so far. So you're not going to get it there. I thought what I would do with these few minutes is just kind of tee up a couple of issues that I think cut across all these different programs we're talking about. State and local public pension plans, Social Security, private DB, private DC, the PBGC, and so forth. And the first really kind of boils down to the question of what is a retirement system even for? Like, what are we trying to achieve? And what I want to try to convince you of there, or at least raise the issue of, is that what we as economists think this system ought to be doing and what the system is actually doing don't really match up particularly well. And then second of all, I want to talk about the fact that risk, in the way that risk is treated, particularly in the public policy sphere and in the accounting sphere and so forth, is just miles away from how we as financial economists think about risk. And frankly, I don't know how else to put it other than I think we as a profession have somehow failed to educate the world about how we see the world. And we'll talk more about that in a moment. So let me first turn to this first issue of what we expect out of the retirement system. And I think if you ask most economists kind of what the purpose of all these programs are, Most of us are going to start with some sort of a model in our head of a life cycle consumer who's trying to smooth consumption over time, over different states of the world, and so forth. Right? And because we don't have these sort of perfect arrow to brew markets out there, we end up relying on insurance products. So we rely on life annuities to insure against longevity risk. We need long-term care insurance to insure against big expenditure shocks and so forth. These markets are not very well developed. They're often discouraged by public policy. If you look at the retirement industry in the U.S., at least until just the last couple of years where things have started to change, the industry has not been focused on consumption or on consumption smoothing. It's been almost entirely focused on wealth accumulation as an end in and of itself. So we think, so really what you should think about if you're trying to model how the retirement industry thinks about this stuff is you've got some terminal age, some arbitrary age, and they're concerned about getting you there with a certain amount of money in the bank. And then they kind of have stopped thinking about what happens after that and how you decumulate wealth or how you take the payouts in a sensible way that help you insure against all these other risks, not just the traditional financial risks that we're used to thinking about, but things like longevity, expenditure risk, and so forth. This annuities on the longevity side obviously have a really important role to play, and we can review some of the research if you want, but basically we've had 50 years now of economic research showing that life annuities, which basically allow you to trade a lump sum of wealth for a guaranteed flow of income that will last as long as you and or a spouse live, really play an enormously important role in the portfolio in most life cycle models. The classic paper from almost 50 years ago suggested that if you didn't have bequest motives and all these other assumptions, you'd annuitize everything. But even when you relax those assumptions, what we find is that annuities ought to play a really important role. And yet what we've seen in recent history is defined benefit plans that have offered annuities have largely gone away and been supplanted by 401k plans. Over 80% of 401k plans do not even offer an option to convert it into lifetime income. The industry is dominated by life cycle funds, which it's a great name, but they stop thinking about the life cycle somewhere around age 60 or 65. They give no thought to what follows. Frankly, even in the defined benefit system that is left, obviously it's kind of on its way out the door, but even in those firms that still have them, what we've seen is a dramatic rise in the availability of lump sum options and a dramatic rise in people taking the money out as a lump sum. Now, if we lived in a world where we thought that individuals were making, fully rational optimizing decisions, that might not be so bad, but, there's growing evidence that the aversion to annuities and lifetime income and so forth is being driven by things like complexity and lack of understanding and framing and so forth, which I'm happy to talk about. And so I will assert, and we can talk more about it if you wish, that people are suboptimally annuitizing, that basically they're not insuring against these risks nearly as much as they should. Now, Bob Merton, obviously a well-known finance guy, has been making the rounds in recent years talking about how what we really need to do is kind of redefine the metric that we're all used to thinking about in our finance models. And instead of thinking about $1 of terminal wealth, think about a flow of constant real inflation-indexed income in retirement. And when you do that, and you sort of plug that framework into some of our standard models, our portfolio models and so forth, you get very different results. For example, you find that T-bills are certainly not a risk-free asset if what you're trying to do is provide a constant stream of income to retirement. You get out interesting findings along the lines about how your savings rate ought to vary with interest rates. You ought to be saving more when interest rates are lower and so forth. And I think that we in the profession need to help, frankly, the industry think more about those kind of issues. This also has implications for how we think about Social Security and minimum distribution rules from 401k plans and so forth, but I won't go into those weeds right now. So that's issue one, which is if we really want to think about the goal of a retirement system as providing guaranteed income or consumption or helping people engage in consumption smoothing, that's not really the industry that we have out there that's focused on wealth accumulation. The second issue that I just want to kind of tee up for a conversation is the fact that I think we've had a colossal and massive and almost universal failure to understand appropriate risk management in the retirement space. This shows up in people not understanding how to discount appropriately. So, Josh and Robert Novi Marks have done a great job of showing the implications of getting the discount factor right in the public sector, and the fact that our state and local unfunded pension liabilities are, $3 to $4 trillion rather than the $800 or million or $1 trillion that is often discussed. People have a belief that stocks are not risky in the long run. That if you just hold on to things with a long enough time horizon that you're somehow going to come out okay. We have governments that consistently fail to price risk when they are putting together government insurance programs and failing to account for the true budgetary cost because of this failure to account for risk. Now, I mentioned Josh and Robert's contribution in the public space. I will tell you, and I don't think Josh would disagree with this, their observations were not exactly met with open arms in the public sector itself, and lacking a strong, coherent intellectual basis for arguing against them. What they basically decided to do was make sort of spurious arguments and then attack Josh and Robert for being, anti-DB plans or anti-union or any number of other things. That is sort of the level of the debate when you enter into the real world on these issues. But there are other places where this comes up as well. For example, in corporate plans, which actually do a better job on the discounting front, the way that they calculate the net periodic pension expense in their accounting rules is to subtract off from that annual expense the expected return on assets. And so this leaves rise, some of you may have seen a case that I think Luis Becerra wrote some years ago, a Harvard Business School case, about how General Motors basically replaced implicit debt to pensioners with explicit debt from the capital markets, and was able to, by so doing, increase their accounting earnings that year by several $100 million. Just by taking credit for an expected return on the assets that was greater than what they actually borrowed at. We see this in public plans with the widespread use of pension obligation bonds. In my now home state of Illinois, we are the leaders at this type of behavior, where basically you borrow money, you invest it in the pension funds, and you claim you're going to get an 8.5% return, and you only have to pay 6 or 7 on the interest, and then you use that to then skip that year's pension payments by arguing that there's leftover money. We also see that on the portfolio side, both in the public and the private sector, there's very little effort to match or immunize liabilities. There's very little asset liability matching. Most public plans, take something like the state of Illinois, basically have constitutionally guaranteed benefits. So they've got a liability, which is essentially a fixed annuity payment, and they're backing it up with pretty aggressive portfolios that, in the old days they would be, 60-40 stock bonds, but now they're into, hedge funds, private equity, and so forth, and they're not recognizing that risk in any way. A final example that I will just throw on the table is you have the Pension Benefit Guaranty Corporation. If you think about what it is that they do, they are insuring defined benefit pension plans so that the participants continue to receive their money even though 2 events happen. One is their firm that they're working for, the plan sponsor, experiences financial distress, and 2, their pension is underfunded at that time. So that basically they declare bankruptcy with an underfunded plan. Well, at that point, the PBGC kicks in and makes good on those payments, and they've inherited tens of billions of dollars worth of liabilities over the years from doing that, and that's expected to grow dramatically in the coming decades. Probably the last thing that you would want to do is take the PBGC's portfolio and invest it in a way that has a risk that is highly correlated with liabilities that you're taking on. Yet a few years ago, Charles Millard, who was at the time the head of the PBGC, said, if third graders in America took finance, any third grader could tell you that diversification reduces risk, and therefore we need to invest more of the PBGC's portfolio in the stock market. Okay, that was the sort of the level of analysis that went into that. Unfortunately, he was no longer director, and by the time that changed, Zvi Bodie actually made a comment at the time that was like suggesting that hurricane insurers should invest in coastal property, which I thought was a pretty good analogy. So the reason I say all of this is I just want to point out to you that what we all take for granted about how we should discount, how we should think about risk in terms of correlations, in terms of states of the world and so forth, those concepts are foreign to most people that are making policy, accounting standards, and designing plans at all levels of government and, frankly, in a lot in the corporate sector. And to whatever extent that lays down a challenge for us to do a better job of educating the public on these issues, I thought I'd tee that up.
Great. Thanks, Jeff. So this, it's great to be here with these guys on this panel. For me, I think we find ourselves, agreeing on a lot of subjects, as Jeff mentioned. I've spent a lot of the recent part of my career looking at issues surrounding pensions and retirement security, and I've found it to be a great set of topics and good combinations of interesting research opportunities, both empirical and theoretical, and also important public policy implications. And it combines a whole set of fields. So for people interested, as I am, in macro, it combines macro, micro, public finance, asset pricing, corporate finance, household finance, and behavioral economics, kind of all in there in the different parts. So for me, that's been really fun. I'm going to again tee up some topics, and there are 4 topics that I've worked on recently and think are important, and they span across the defined benefit and defined contribution world. The first one has to do with valuing and hedging pension liabilities, and the role, in particular, the role of wage risk in that in valuing and hedging. The second is the complete transformation of the pension landscape that we've seen from defined benefit toward defined contribution, trying to understand a little bit about why that may have happened. The third one is to ask how well do individuals handle the increased responsibility that they have been given by being in DC plans. And the fourth one has to do with managing the payout phase in defined contribution plans, and particularly the role for annuities, which overlaps some with the kinds of things that Jeff just spoke about. So let me take each of those 4 topics in turn. The first one, again, valuing and hedging pension liabilities. And the big question there, one of the big questions there, is what discount rate to use to value pension liabilities. In some work that I've done with John Giannakopoulos and Debbie Lucas, we focus in particular on the implications of wage risk, because pension liabilities are often tied to wages. And in particular, if you look at typical private defined benefit plans, the payouts are tied to your highest wages over some part of your life. And when you look at Social Security, it's even a stronger link, because Social Security benefits are wage indexed. So they're indexed to the average wage, and therefore depend on what the economy-wide wage is at the time just prior to retirement. So there are tight links between wages and these liabilities, and the payout structure of these liabilities. And we argue in the work that we've done that wages basically have a positive beta, that wages are positively correlated with aggregate economic activity, whether it be consumption or the stock market, whatever variables you're interested in for asset pricing, that wages are going to be correlated with these, and that correlation likely increases with the horizon. And so that on the short run there may not be much correlation, but over long horizons, that those correlations, those betas, tend to be quite high. So when you take that into account, this has implications for the term structure of the discount rate that we use for discounting pension liabilities. So first of all, we find that the appropriate discount rate is higher than the risk-free rate. There's a risk premium built into it. And also that the term structure of those risk premia is upward sloping. So the difference between the discount rate that you use for wage-linked claims and the risk-free rate is upward sloping with Horizon. So I think there's some quite interesting implications of this. And in the Social Security realm, we find that the discount rate used by Social Security is too low. Now, why is that? Basically, the actuaries at Social Security use the expected return on the assets to discount the liabilities. It's the same thing that's done in public pension plans, except it happens that the trust fund in Social Security is invested in riskless assets, and therefore they use a riskless rate to discount Social Security liabilities. In the public plans, they tend to hold a lot of stocks, and therefore they use something like 8% to discount the liabilities. So it's actually the same mistake, but it goes in the opposite direction because of what the assets are invested in. On the Social Security front, they're discounting these liabilities, again at the riskless rate, but in fact wages have a positive beta, and therefore there's a positive risk premium that they should use. And when you use the right discount rate for Social Security, you actually end up, the right discount rate is actually higher than the risk-free rate for Social Security, and therefore the liabilities of Social Security are actually somewhat smaller in present value than the actuaries typically find, because the discount rate is higher, making the liabilities somewhat smaller. So it's an interesting example where I think the same conceptual mistake leads to very different answers. Now, of course, the future contributions to Social Security are also linked to wages. So when you do various actuarial measures of Social Security, you have to take into account the risk, not just in the benefits that are paid, but also the wage risk in the assets. In the future inflows to the program. And in our work, we've done some measures of that to look and come up with overall assessments of what the unfunded liabilities of Social Security. The bottom line is it's typically smaller. The unfunded liability is typically smaller than is commonly perceived, but nevertheless still very large. So it's not like the Social Security system in present value is balanced. It's just that it's not quite as much of an unfunded liability as is popularly believed. The other implication of this wage risk is that some policy changes that might appear to save money, such as changing from wage indexing to price indexing in Social Security, might not actually do so when you examine it on a risk-adjusted basis. And the reason is that again, on an expected value basis, it's cheaper to do price indexing than wage indexing. But on a risk-adjusted basis, because there's some chance that wages will end up being really low in bad states of the world. If it's wage index, that's cheaper for Social Security in those states of the world. And those are the states of the world where a dollar is really valuable, because those are the crisis or disaster states of the world, for example. So we find that incorporating risk adjustment can actually change both our assessment of the measure of liabilities. It can also change the assessment of public policy questions such as wage indexing versus price indexing. And it also has implications for investment of the trust fund for Social Security. And we argue that investment in stocks can possibly help hedge long-run wage risk. And there's a potential role for holding stocks in Social Security trust fund. The second topic has to do with the transformation in defined benefit pensions. And one of my favorite graphs that I like to show is the coverage of workers by DB plans versus DC plans. And you just see this huge X-shaped transformation where, 30 years ago we were at 60% coverage of defined benefit plans, and now we're at something like 10% coverage by defined benefit plans. This is conditional on having a pension plan at all. And so 60% only had a DB plan back in the past, and now it's like 10% only have a DB plan. So this huge transformation of the pension landscape. One question that arises here is what caused this? And one of the things that Josh and I have looked at are the roles of various factors in determining pension freezes and the transformation from DB to DC. That's one of the mechanisms. And one question is, did it save costs? Did it save firms money to shift from a DB to DC? We argue that it has, and there's a couple possible reasons why it may have saved costs. One is there may have been a reneging on implicit promises to workers of high accruals at the end of their career. So the pension accruals in defined benefit plans are quite low as a percent of salary when you're young, and quite high when you're old. And so it's possible that there was some reneging by freezing a plan on that implicit promise. And the second is that it may be that the true costs of DB pensions are higher than the valuation by workers. And for some reason, workers don't seem to value plans as much as it costs firms to provide them. And I think that also opens up the role for some cost saving by freezing and transforming to something like a DC plan. The third topic is tied into this big X-shaped graph that I said, and asks whether individuals are how well individuals are doing at managing the decisions that they have to make, given that they're in this DC world, that they're in a world where they have much more financial responsibility. And to understand why I think, I'm going to argue that people are not doing a particularly good job, that there's obviously a variety across and heterogeneity in the population, but that there's a lot of people who are not doing a good job. And I think to understand why, it's important to incorporate behavioral economics into discussions of household finance. In fact, I've been teaching for the last couple of years a course in the business school at Columbia called The Psychology and Economics of Consumer Finance. We're teaching this to MBA students. And doing this jointly with Eric Johnson, who's a psychologist and marketing professor. And there we investigate a lot of the role for behavioral issues into household finance. So my view on what's happening with households is that people are required to be making decisions that are really complicated, and in many cases too complicated for them. And so I think a few fundamental reforms are needed. The first is improving product design, making things easier to understand, suited to people's needs, and more transparent. I think we need to improve the choice architecture, to use the principles of behavioral economics to nudge, to use Dick Thaler's term, to nudge people into decisions that are likely to be best for them, without necessarily requiring them to make those decisions. Third thing I think is to improve financial literacy, particularly at younger ages. I think most of the evidence shows that if you wait until people are in the workforce, it's too late and too expensive to do it, and it's not very effective. But I think there's some hope for that at younger ages, at kind of middle school and high school level, teaching financial literacy to students. And the fourth is I think we need to fix our advice system. I think there are a lot of problems in the way that financial advice is delivered to households in the United States and around the world, having to do with partially with the lack of financial literacy, partially due to the lack of agreement among experts on what's exactly the right thing to do, partially about the privacy that people place about when they talk about money. It's probably second only to sex and the kinds of things that people don't like to talk about in detail. I mean, they talk about generally about it, but not about their own personal situation. And then fourth is I think there's the really lousy incentive structure for financial advisors. That many are paid. Just the way that the typical fee structure is done, I think, is problematic, and I think we need to reform that as well. And the last topic I'll just mention, because I'm out of time, and Jeff has already gone through it, and that has to do with annuitization. And I think I agree with Jeff that we need to spend more time and energy looking at how to incorporate lifetime income into DC plans, and again, I think it's a combination of product design and the choice architecture as well in this realm. So let me stop here.
Great. Well, I just wanted to add a few things to some of the things that the panelists said. One of the themes that kind of came up repeatedly was how in public budgeting, governments don't seem to think about risk the same way that finance economists think about risk. And I'm going to pose some questions to the panel for general discussion, but before I do that, I just wanted to highlight a few of the implications of that. What is really the problem? What are the problems that that creates? And I think the sort of classic example is, as we've alluded to, most state and local governments still use discount rates of close to 8%, some have maybe lowered to 7.75%, in order to measure both accrued pension promises and the cost of new promises that are made, and that these discount rates are based on the expected returns on their assets. Now, if a government were given complete discretion to choose the discount rate for this calculation, it wouldn't escape their notice that a higher rate allows them to assign an apparently lower cost to benefits. And as it is, governments only need to justify their discount rate with an expected return on their assets, which they can often do based on historically realized returns, and that seems to be good enough for some. So their response, the response to falling yields on safe securities by state and local governments has included shifting the investment portfolios of the pension funds deeper and deeper into alternative assets, private equity and hedge funds, in order to continue to maintain an expected return target near 8%. Now, it doesn't take a very sophisticated Monte Carlo analysis to prove to yourself that by targeting an 8% return with risky assets, maybe you assume log normally distributed returns, that public budgeting is actually being conducted on the basis of a return scenario that will be achieved in maybe 1/3 of the states of the world. You know, it depends what volatility parameter you want to put in there, you know, with a median of 6% or less. So the first main consequence of this that I see is that we're basically doing public budgeting towards a scenario that's only going to be achievable in about 1/3 of the states of the world, and these are also going to be really good states of the world where, you know, the shadow cost of raising new revenue if need be would be low, whereas the states of the world where the pension funds do poorly are those where the shadow cost of raising a dollar is high. I think the second consequence of using expected return discounting and not accounting for risk properly is the fact that the ongoing budgeting distorts the budgetary picture. So indeed, while 49 out of the 50 U.S. states have some balanced budget requirement, in my view, no state or local government that sponsors a pension plan has run a balanced budget in an economic sense in a very long time. And that's because we're simply granting the promises of deferred compensation and discounting them back at rates that don't reflect the promise. And I should say that, you know, it may be, given where we are, that the optimal funding strategy is not to fund fully with, to fund these unfunded legacy liabilities fully with Treasury bonds. But it's harder to make the argument that on a prospective basis, when the accrual of these new debts is in some sense optional and something we could stop if we wanted, that we should be continuing to grant new benefits and measure them using these expected returns and funding accordingly. Indeed, the nature of this contract means that we're basically giving future generations, we're making them write insurance on the stock market for us to a fairly large extent. So to continue to justify using this funding strategy, we would need some reason why on an ongoing basis we should be borrowing money from the public to invest in the stock market. And the third consequence and the last consequence I just wanted to highlight was that this kind of ignoring risk also distorts the analysis of reform plans. So I think one very good example is what John proposed, which is raising the retirement age, which I think most of us up here would just have to agree that, hands down that there's, this is going to have to be part of any reform proposal to deal with just about any of these issues. The problem is, in these state and local pension systems, if you raise the retirement age to 70, there would still be major undercosting of these funds because the actuaries would turn around and say, okay, great, now that you've raised the retirement age to 70, you can lower your contributions because you don't need to contribute as much. It would be better if the retirement age were 70 from the perspective of solvency than if it were 62 or 58 or whatever it is in various plans, but there would still be undercosting and there would still be new unfunded benefits being generated. And a related example, one of the very touted points of a recent pension reform and much touted pension reform in California asks public employees to pay half the costs of their pensions. And the public looks at that and says, well, that sounds very fair. Now they're paying half the cost of their pension. Well, because the pensions are undercosted by a factor of about 2 or 2.5, they're really only being asked to pay about 20% of the cost of their pensions. So this ignoring risk really distorts the analysis of public budgeting and of reform plans. So those are the comments I wanted to add. So I want to turn to some questions that I'm going to pose to the panel and maybe have some views on myself. But the first question I wanted to turn to Social Security a little bit and ask the panel to just comment on the extent to which they view Social Security as a difficult problem to fix or not. What are the clear policy prescriptions? And is this an area for large concern, especially given the wage correlations, and also perhaps given some low-hanging fruit that research has kind of highlighted as things that we can do? You want to comment on that? I know we have 3 Social Security experts up here.
So here we may have some disagreement, but I actually don't think Social Security is all that difficult to solve in terms of its solvency. Syl Shevers in the audience. Syl and I wrote a paper which analyzed progressive price indexing, I think was the term it became known as, which was basically to wage index people with low lifetime incomes and price index people with high lifetime incomes, and if you're in between, you've got more than prices but less than wages. And that alone, the way, it obviously depends on how it's specified, but that could eliminate 75% of the unfunded liability. So suddenly when you've got 75% of the problem solved, then other solutions, such as raising the full retirement age a little bit, would finish the job. So I don't think it's all that difficult. It's very frustrating because the problems of Social Security solvency have been known for at least 20 years, and they've only gotten worse, or at least they've gotten closer, which in present value terms means that they're worse. So I'll leave it at that.
Yeah, so I was emailing a friend of mine yesterday whose birthday it was, who worked with me on the Social Security Commission in 2001, and I remembered that we were in this very hotel room when we held one of our public hearings about Social Security. And at the time, that commission came out with a proposal that was sort of, change the way we index this thing. And over a couple of decades, it completely eliminated the problem. That same policy today doesn't work anymore. And the reason is that 11 years have gone by, and we've replaced 11 years of surpluses, cash flow surpluses. And we've just sort of, when you have a situation where you've got a revenue line like this and a cost line that's kind of going like that, you wait a few years and the problem just gets that much harder to solve through minor changes. So notwithstanding the wage price critique that Steve made, this isn't a relatively easy thing to do. Sil was on a commission in the 94, 96 Reform Commission that put out proposals. The 2001 Commission put out proposals. Academics have put out proposals. I could give you 100 different ways to do this that solve the problem. The difficulty is a political one, just purely a political one, because there's really no simple way to do this without cutting somebody's benefits or making someone pay more, or as Alan Greenspan said, repealing laws of arithmetic, which I think Congress tried. The thing that I will say that's a little harder, not harder than the political, but harder than sort of fixing it from an accounting perspective, is to really think about it as an economic issue and ask questions like, along the way, can we do things to better encourage saving, to better encourage labor supply, some of the kind of stuff John's been talking about. Those, I think there are some really excellent ideas out there, but those are not as much in the DC-based policy discussion, which I think is a missed opportunity.
Let me just add an amendment to what I said. The life expectancy of people in their 60s, the remaining life expectancies, has gone up by 30% in the last 50 years. So actually, Social Security benefits have risen a great deal. When you raise the retirement age, you're not lowering benefits, you're just offsetting the automatic increases that happen all the time due to longevity.
So I would agree with John and Jeff that Social Security is relatively easy to fix, and I think that it's been problematic that we haven't fixed it to date, because I think every year that goes by, Social Security's reputation suffers from it, and all the talk about a crisis and about Social Security falling apart reduces the public's confidence in Social Security, and I think that's problematic, and it's a huge reputation hit that Social Security is taking, when if we had done this 5 or 10 years ago, had made these relatively minor changes, we wouldn't have had to suffer through all that. So I think it's important to make these changes. The shortfall is a couple % of payroll. I think we could fix that through raising the cap somewhat on Social Security, to bring it back so that the percentage of wages that are covered by Social Security is sort of back where it used to be. I think we could raise Social Security tax rates slightly. I think we could have some very long-run and gradual benefit reductions. And I do think that I don't completely agree with John on this issue about wage indexing, because even though wage indexing is generally more expensive ex post, it is less expensive ex post in certain states of the world, and that's the state of the world where the economy falters, and that's the state of the world where you really need the money, where money is really valuable, both to people and to the government. So I think you have to be a little careful about that issue. But I think we all agree generally that it's fixable.
There's an easy fix to that, by the way, which we didn't think of in 2001, but people pointed out with this kind of critique, is that instead of moving to wage versus price indexing, you just take the wage indexing minus 1%, which is the projected difference, and you just do it that way. And then, therefore, you preserve the risk management aspects, but still get the savings, and I think that's probably a better way to do it.
You know, it's interesting because I think some of us up here are more concerned about state and local pension systems and the threats that they pose to, at least the challenges that they pose to state and local finances. I'm wondering if maybe some of us, I'm happy to chip in a little bit on this as well, you know, could just say a few words about why that is. I mean, on the face of it, I mean, Social Security is essentially a completely unfunded pay-as-you-go system. I mean, there's a trust fund, but we know that it's invested in treasuries and, in a sense, an accounting operation, whereas public employee pensions are actually funded. So what's the problem here? How could it be that Social Security is easier than to deal with than state and local?
I'd be happy to jump in on this because I've been knee-deep in the Illinois situation for the last year or so, trying to get them to move on this. There's a couple of important differences. First of all, Social Security is much more capable of running on a pay-as-you-go basis than a state-level public plan, just because it's awfully easy to move across state borders for capital and labor to move across state lines to escape the unfunded burden than it is for people to move across national boundaries to escape the unfunded liability of the Social Security system. So it is becoming a very tangible issue in the state of Illinois, knowing how bad our pension system is and knowing it's not so bad in Indiana and not so bad in Wisconsin. You know, for that matter, Governor Christie from New Jersey was blasting billboards throughout the state of Illinois inviting businesses to come to New Jersey. So that's one issue. I think it's just bad long-term sort of economic policy for a state to try to run an unfunded system. Second, in 7 or 8 states, including Illinois, as well as New York and a few others, there is a constitutional guarantee of state retirement benefits. Now think about that for a second. Right? This is an employee benefit program, so even in the states where it's not protected by the constitutional specific clause, it's protected by contracts provisions. This is not a social insurance system like Social Security where Congress is allowed to change it. States have their arms, both arms tied behind their back from a legal perspective in terms of their ability to do much about the current unfunded liability. There have even been some legal opinions, haven't been tested, that the language of the constitutional non-impairment guarantee in Illinois not only applies to already accrued benefits, but applies to all future benefits for existing employees. So it would say if you were 22 years old and you'd been hired under the system that they can't change your benefit formula. Now, if that's the case, then I'll be looking for a job outside of Illinois if the courts rule that way. But that makes it a much more difficult issue to deal with as well. It's just that it's not obvious what the solution is. So in the state of Illinois, all the things we'd like to do, raise the retirement age, clawback benefits, make people wait until they're in their 60s rather than 55 to retire, we can't do them. And there's just a lot of things you cannot do. And one last point, and then I'll turn it over. One of the ideas that we came up with, and it kind of goes against everything I believe in terms of the importance of annuitized income and so forth. They have this automatic every year, regardless of inflation, 3% automatic annual increase of benefits once you've retired. We said, what if you just allow people to lump sum out of that, right? So people love lump sums. We know that people will take a huge haircut. Basically, you can apply a really big discount rate and people will still take the lump sum and you could save a lot of money that way, right? Turns out that because of the government accounting standards where the benefits are already being discounted at like 8%, then unless you discount the benefits at like 9%, you cannot show a cost savings even when long-term interest rates, what's a 30-year treasury these days, 2 or 3%? So you could have in actuality billions of dollars of savings and actually have it show up as a net increase in the cost in terms of how these things are accounted for. So, it's just fraught with problems all the way around.
I think the politics are difficult as well. This is one where it's, these are not Social Security is basically a universal system, other than the 7 million public employees who are outside of it, whereas the public employee systems is one where you have 90% of the population owing 10% of the population. And it's even trickier because that 10% of the population is providing essential, valuable services to the public, such as teaching and public safety. I think you also have even worse politics, because you have the people with the shortest horizons generally sitting at the bargaining table. You got the most senior public employees, and you have the public officials, and you put them together, and they're not necessarily looking out for the long run. And then finally, I mean, there's each state has its own laws, no state has its own currency, and there's no sort of bankruptcy chapter or workout mechanism. So I think that kind of adds to the degree of concern. But in terms of defaulting on benefits, I mean, is defaulting on benefits possible? Because we have seen in both Rhode Island and New Jersey that cost of living adjustments were suspended. We've seen in Rhode Island the equivalent of basically a partial freeze of pension benefits. In other states, it seems to be more difficult. So, do we think there's going to be a wide heterogeneity of outcomes here, or is it just all going to ultimately be solved maybe through some kind of federal government intervention? Nobody wants to speak to that. No one wants to answer that. Steve wants to answer that.
Well, I mean, you are going to get heterogeneity because Illinois could not do what Rhode Island did because we have the non-impairment language. And like I said, there's 7 or 8 other states that have that. Even in the states that don't have it, there have been different state-level court interpretations of the strength of the contracts provisions. So, for example, in the state of Indiana, the courts have ruled that pensions they literally use the term mere gratuities, and they can be taken away at any time. So they have basically infinite flexibility to do what they want. In many other states, that's not the case, and there have been states that have struck down reductions in the COLA. So I think because of the legal infrastructure in which we're operating, you're going to end up with tremendous heterogeneity in how these things play out.
And what about just the behavior of participants in public employee pension plans or in Social Security? I know, John, you have some work on how people decide to claim Social Security. Does that provide any actionable policy recommendations for how to deal with some of these issues?
Well, let me just describe what I've been working on. I'm not sure I'll answer that question, but I'm close. So the typical retiree today, they retire, they immediately claim Social Security, and then they try to use their 401k to supplement their Social Security checks. I think that describes how most people, at least in the private sector, try to fund their retirement. And I'm claiming they've already made a mistake. So all I said is they retire, they claim Social Security, and they try to supplement with their 401k. And I say, I claim they've already made a mistake. So the mistake they've made is, rather than trying to supplement Social Security with their 401k assets, they should have tried to defer Social Security with their 401k assets. And the rates of return to Social Security deferral are actually quite extraordinary in today's markets. They are not determined by markets, they're determined by legislation. In some cases, that legislation is 60 years old. The rate of return that you can get for deferring Social Security depends exactly on your circumstances, but could easily be 5 or 6% real. Inflation index, government obligations that are offering you 5 or 6% real. Well, ask yourself, where else can you get 5 or 6% real? So people are passing up an extraordinarily good deal by simply waiting to start their Social Security. Some of you know the facts. For instance, if you start your Social Security at 70 instead of at 62, you get 76% more money per month, also inflation adjusted, while you wait. There's no private annuity that's going to offer you anything like that. So basically, by deferring, you are buying a larger annuity with the foregone Social Security benefits that you're not taking. And it's an extraordinary deal. So I don't know. I mean, I think people do make mistakes. Maybe maybe your course on psychology and financing will tell us why they're making these mistakes. But to me, it's unbelievable how few people are taking advantage of an extraordinary deal. For a married couple, they can pick up a couple $100,000 in present value by optimally deferring instead of starting immediately. That's a large number by any measure. It's larger than the typical 401k balance. It's a large number, and maybe even in this audience, it's a large number. But anyway, so I'm writing a booklet called Efficient Retirement Design, and it's with Sita Slavov, and we're going to try to distribute this in a novel way, namely free and electronic, and we're going to try to see if we can't change behavior. One group that may not love this are the retirement advisors or the financial advisors, because I'm saying you should spend down your 401k assets, the stuff you're making basis points on. And they say, wait a minute, I want to keep that around as long as I can. That's my gravy train. But anyway, that's what we're trying to do.
This would impact government solvency, right? If everybody took this better deal, then, I mean, it's the other side of the coin.
Not necessarily. Would this make Social Security worse off? It depends how people finance their deferral. One way to finance deferral, in fact, the way that many people would have to finance it, is to work longer. You say, wow, the deal at 70 is sure a lot better than at 62. Now, if I had a huge 401k account, I could use that to get to 70, but if I don't, I'm just going to have to work longer. So if more people decide to work longer, then it wouldn't hurt the government finances that much, or maybe not at all. But if they did it from the 401k sense, yes, it would.
Just quickly, I would say, I agree that that's a sort of an optimal strategy in a world where we have these early retirement ages. My guess is it's going to be very hard to get people to do that. We've got some research right now from Croatia, of all places, where people were given a choice between essentially an annuity and a lump sum. The internal rate of return to taking the annuity in real terms was over 20%. 70% of the population took the lump sum. It's just everywhere we look, in every country in the world, and I can point you to study after study after study, people have an amazing aversion to engaging in these kind of transactions. So I think if we're serious about it, we just need to raise the retirement age, and that's going to be the quicker way to get people to delay taking Social Security.
I don't completely disagree with Jeff. In fact, let me just note that a lot of studies are, why don't people buy annuities? Actually, the people who have DB plans, particularly private DB plans, some government DB plans, they actually sell annuities when they settle for the lump sum. They're basically, so they not only don't buy them, but when given an opportunity, they sell them.
So yeah, I agree that people that it would be. I agree with both of these points that deferring the age of collecting Social Security would be a good thing for many people, and just putting in a plug for your work with Jeff's work with Olivia, where some of the way that these choices are presented and have historically been presented to people by Social Security seems to deter people from claiming later. Right, this whole break-even analysis that Jeff has talked about. That Social Security's own literature has kind of guided people toward claiming early without maybe even realizing it. So I think that I think there's scope for developing both better communications materials and better institutions and products that will help people cover this gap period between when they perhaps want to start working and when they want to start receiving Social Security benefits.
So just one last fact. When I started talking at the very beginning today, I talked about second to die and couples and so forth. So in that kind of demographic analysis, I looked at what the average length of time is that the survivor of a couple outlasts their spouse. How long does the period, I'll call it widowhood, although actually in about 1/3 of the cases, the men outlive the women, and about 2/3 of the cases, the women outlive the men. But the average length of that survivorship is about 10 years, 10 to 11 years. It's a long stage of life. And that survivor is the major beneficiary of the deferral strategy, because the deferral strategy, the survivor gets the higher of the two benefits, and if the higher earner deferred, then they're going to get a much bigger survivor benefit.
All right, I have three more questions for the panel, and then we'll open it up to the floor. So the first question is about inflation. So if we had a period of increased inflation, what would that do both to the retirement adequacy side of the coin, and also to the government solvency side of the coin? Do we have any thoughts on that? Because the future may look a little bit like that. It's at least a conceivable state of the world.
So I'd say, first of all, putting on my macro hat, I'm not particularly worried about higher inflation, certainly in the near term. I think the slack in the economy that we're seeing right now is strong enough, and that I'm not worried, as some are, by seeing the balance sheet of the Fed. I'm not worried about higher inflation in the short run. That said, many of the programs are inflation indexed that we're talking about. So whether it's Social Security is inflation indexed, there's some discussion about whether to switch from the regular CPI to a chain-linked CPI, which would have a small difference in benefits. But many state and local plans, pension plans, defined benefit plans are inflation indexed. And so then you're down to on the DB side, there's not a lot of inflation indexing, but there is sort of ad hoc inflation indexing, which is kind of a strange way to do things. So there might be some impact there on the private DB plan, but those are diminishing in importance over time in any event. And so then we're left with the DC world, and there, it really depends on the kind of portfolios that people hold and how well hedged they are in those portfolios. And I think that I would like to see an increased role of inflation index bonds, and I'd like to see people holding more of those relative to nominal bonds, just as an inflation hedge in case this happened.
I mean, these life cycle portfolios typically do not shift you into much in the way of tips. They're typically shifting into nominal treasury bonds.
So I think long government bonds, 10 years and longer, are incredibly risky, and I'm worried that some of those people are going to have those portfolios. They've been told that, get out of the stock market into the bond market as they approach retirement. I think a portfolio of 10-year or longer bonds is pretty risky, nominal bonds.
Okay.
Because of the inflation risk, or because of the real interest rate risk? The inflation
Both.
risk.
Both.
Yeah.
Second of the remaining questions I wanted to ask was, Jeff, you brought up the point that we need to do more or think of ways to bring these fundamental ideas about risk to the public policy debate. Is there any hope of? I mean, what are the hopes of being able to do this? I mean, in your experiences, are you optimistic that we're going to be able to succeed in doing this?
I really wish I knew the answer to that, and I don't. And maybe there are some much more creative people in this room than me. A number of us, we had an email list with a bunch of pension scholars, and including a lot of people you guys all know, Bob Merton and Bill Sharp and lots of others. Bill Sharp actually resorted to making one of those little cartoon videos of like two little cartoon people talking to each other about this kind of stuff. I think that's kind of the level that it's going to take. The problem we have on all this risk stuff is that for people that do not have training in finance, it is very, very intuitive and common sense for them to say, if I want to figure out how much money I have to put aside today, I should just sort of look at what return I expect to get. And if you try to explain to them, like if you use the word states of the world, or you try to explain to them how a dollar is worth more in a bad economy than in a good economy, I mean, they have no idea what you're talking about. So we have something that we think is core to our profession, and the fact of the matter is we have not figured out a very good way to explain it to the general population and the policymakers that haven't had a couple of semesters of training in it. And maybe some of you can help solve that, but frankly, I don't know how.
Okay, well, that tails into my last question, which is, regarding these problems of state and local government budgeting, You know, are there paths for the federal government to increase its involvement in this issue? I've seen sort of three vague things that have been floated, or vague ideas. Some have made their way all the way to becoming congressional bills, but others have just been policy ideas. You know, one has been to set up sort of a form of ERISA, which is the framework that governs the corporate defined benefit pension space, and that regulates that, and that also provides insurance, to set up a sort of ERISA for public, you know, state and local governments. The second one is just to say, look, what we need is a state-level bankruptcy procedure so that there is a resolution mechanism for states, and that could potentially supersede, you know, maybe give a framework for superseding other laws that the states had written. So that's something that's been that David Skeel, law professor at the University of Pennsylvania, has been very active in. And the third is there was an act put forward, the Public Employee Pension Transparency Act, put forward in Congress that would require state and local governments to provide an accounting of their pension liabilities using government bond yields. And it didn't require anything else, didn't require funding or anything else, but just a, you know, requiring a disclosure on that basis, under the notion that, you know, there's this chance that these state and local government liabilities could ultimately become federal liabilities, that at some point some state could ask the Federal Reserve to, you know, start, you know, bail them out or start buying their bonds. And in exchange for that, we at least want to have a disclosure and more transparency. So, you know, what are the hopes for any of those three, or should the federal government be getting involved in this problem with state and local finances, or should they be stepping back and letting the problems run their course?
Happy to talk about this one too. So first of all, on the ERISA idea, the notion of having a PBGC for public plans, I think all one has to do is look at how successful the PBGC for private plans has been. The PBGC is currently about $30 billion short. That's projected to rise to over $100 billion over probably the next decade or so. Congress has not granted them authority to risk adjust premiums. So if you're a well-funded, conservatively invested, somewhat meager DB plan, you still pay the same premium as one that's, you know, has a very risky asset portfolio, lots of asset liability mismatch, really generous benefits, and so forth. It's just, and it's not just the PBGC. I ran a conference about, I guess it's been about 4 or 5 years ago now, and I brought together scholars to look at the FDIC, the PBGC, crop insurance, terrorism insurance, all these things. It is a consistent theme across all these government insurance programs that they fail to risk adjust, they fail to set premiums at the appropriate level, and so forth. So I don't like that particular idea. The transparency issue, I would say, and actually when I met with the GASB board a year ago, what I told them is, I said, look, if you guys don't want to take a position on what the right discount rate is, just report the cash flows. Just tell us what your projected cash flows are for each year, and then, you know, Josh and Robert can do their thing, and GASB can do their thing. People can discount it the way they want. They seemed receptive to that, although they didn't actually implement it. The one place where I think we might get some traction are some of the rating agencies, because I think the rating agencies, you know, Moody's in particular, have been taking an increasingly aggressive stance toward the public pension plans, and I think they may end up forcing some more disclosure relative to the threat of downgrades and so forth. So we may get some action there, but I think we're better off kind of leaving that to the markets, or at least just disclosing the cash flows.
I guess I think it's important for us to work out in our own minds what would happen in different scenarios in which a state got into trouble, a state or a local government got into trouble, and in particular ask the question: would the federal government step in certain situations? So, for example, if Illinois could no longer pay its pension obligations and was sort of on the verge of declaring bankruptcy, for example, the whole state, would the federal government come in and help? And I think if the answer is yes to that, we are better off having some kind of an explicit ex-ante government guarantee program than having an ex-post ad hoc program. And I think we've learned that from some of what happened in the financial crisis, and we've also learned that from some of what's going on in Europe on that situation. So And I don't know the answer to the first question, whether whether the federal government would step in and help, or would they just let Illinois go down the tubes. I don't know if you guys have a view on that.
I mean, I just wanted to, I'm waiting for someone to write the paper. It's more of a theory paper, I guess, about whether a poorly designed ex-ante system, under what circumstances it's actually better than an inefficient ex-post system, because that really is the real-world trade-off. I mean, if you look at how the government has designed insurance programs, it's not going to design sort of the idealized, risk-adjusted, so forth. So what you have to ask yourself is whether an explicit ex-ante system that has poor risk adjustment, leads to moral hazard concerns and so forth, is better or worse than a bailout system after the fact. And it could absolutely go either way. And so I'm just a little less confident that even if they're going to bail out Illinois, that's going to lead to a better result.
It's not quite what we're talking about, but I do think in the next few years we're going to see tested legally this idea that you can't reduce benefits for future accruals. And it'll be interesting to see. I think that may be pushed in California. The city of San Jose is thinking of taking that to the California Supreme Court. So we'll see whether this is going to hold up or not, whether this 22-year-old employee really does have his pension system locked in for the rest of his or her career. And I think the legal scholars are uncertain as to how that's going to turn out.
And the COLAs are the other place where there's been some traction. I mean, I think ERISA is pretty clear that a cost of living adjustment is an accrued benefit, but some of the state governments have had some more room there, particularly New Jersey and Rhode Island, but I don't know whether you could see the same thing in California. You know, there's also a question in my mind, at least, particularly sparked by some of Steve's work, as to what kind of COLAs do people actually really want? I mean, do you want to say a few words about that? I mean, do you think that the kinds of plans that are out there are providing people with the kinds of cost of living adjustment that they actually want?
I think it's an interesting question, because when you look at there are large variations in the kinds of cost of living adjustments that are present in different systems, right? So in the public system, well, in Social Security, we know it's built in and indexed to prices. In public plans, we've seen almost universal inflation protection. On the other hand, in private DB plans, it's not there that often, and in private annuity sales, it's almost never there. When you look at sales of single premium immediate annuities, very little of those are sold with COLAs built in. And so it's an interesting question as to why this is. In work that David Leibson and others and I have done, where we look at, we've asked people in hypothetical situations what kind of slopes they want for their retirement income streams. And they seem to, and this is of course, the trade-off is starting at a higher level and not rising with inflation, or starting at a lower level and rising with inflation with the same present value. And people do not seem to want declining real profiles, which is the typical thing that you'd get if you don't have a COLA. So people seem to want either flat real or even rising real profiles, even understanding that they have to pay for it. So I think it's still an interesting question as to why these differences exist across different scenarios, and how to encourage, well, within the annuity market, how to reconcile the fact that people seem to want rising or flat slopes with the fact that they don't buy it in single premium immediate annuity market. So.
Okay, panel, anything else to add? Let's open it up to the floor. We're happy to take questions and struggle to answer them as best we can. There's a microphone up here, so.
I'm Syl Schubert. I published my first book on Social Security it came out in December of 1982. And there was a widely perceived crisis at that juncture. The reason was that within the next 4 months, they weren't going to be able to make Social Security check payments, full check payments. And by March, legislation was in place to address at least the short-term financing issue. Now, we can talk about solving these problems and coming up with mechanical ways to do it, and that it's easy to solve the Social Security financing problem. And as I think Jeff said, there's hundreds of proposals. John and I have worked on proposals. John's worked on proposals with other people. Many of the people at that table have worked on proposals. But at least in the area where I live, during the last election campaign, we were regularly entertained with commercials during the news hour with people from the AARP and other groups of that sort, having very fine-looking people about my age, talking about how they had paid for their benefits, and nobody damn well better touch them. And if you think about the discussion that we just had within the last couple of weeks about the fiscal cliff, the debate on one side, or the argument on one side was, we are not going to do anything to adjust Social Security benefits to adjust this issue. Social Security is not the financing problem. As much as we think these things are a crisis, I think we're arguing that we've got a different time perspective than the people that are actually voting. The people that are actually voting can sit here and say, Social Security is not a problem because at least theoretically we've got money in the bank to pay the benefits for the next 20 years. Now, the illusion has been made, or even the statement has been made to the point here a time or two, that there's some, maybe not always terribly sophisticated, but in some cases sophisticated mathematical issues behind the pension issues that we're dealing with. And we're dealing with a political system that is not looking at those arithmetic or those financial issues, those mathematical issues at all. Their mathematical issue is who's going to vote 2 years from now, and how are they going to vote, and how are they going to perceive what it is the policies are that they need to be thinking about in order to make things well for whatever their time horizon is. That's the crisis we have. We're not having a discussion here. We're having a discussion about mechanics. And the crisis isn't about mechanics. If we can't figure out the mechanics, then there is a crisis because you guys' arithmetic isn't good. But the problem is somehow it's not being translated to the people with a vote with a sense of urgency that we can't wait until we get down to within 3 months of not being able to make a benefit payment. I have a sister who's been teaching in Illinois for years, and she's going to retire a year from now, and she believes she's going to get her pension benefit. Now, you know, that she understands this political discussion that's going on. But there's money in the bank to pay benefits for a while. And her life expectancy, I'll let John help her figure it out. But, you know, somehow the rational arguments that are being made here aren't being conveyed to the people, first of all, the people that have a vote, but also to the real people who are the owners of all of this. And, you know, maybe even worse than who owns it immediately. You know, my 5-year-old, 3-year-old, and 3-month-old grandchildren come to visit me fairly frequently. And when I sit them on my knee and I tell them about what we're facing in Social Security 25 years from now, you know, they're certain that I've had one too many beers. You know, so this is the issue. I think we've got totally different time frames than almost everybody else in the discussion.
So maybe we need to, you know, in 1983, they did raise the retirement age, but they didn't do it, they didn't start doing it until 2000. And at the time, it seemed like that was forever in the future, and who could care what happens in 2000? Maybe we need to repeat that, and, you know, for instance, if we're going to raise the retirement age, do it starting in 2020, which seems like a long way away. It's actually not very far away, but at least it's 2 or 3 election cycles for House members of the House, so they could maybe get away with it. And all these other changes, but as you know, I mean, 20 years is not very far in the future. The average retiree today is going to outlive the trust fund.
You know,
So-
but what was in 1982? I mean, it's hard for me to believe that if they hadn't taken action, that benefit checks would have stopped. So I'm a little bit. I'm just trying to figure out what created the
The
urgency.
benefit checks won't stop. If they're collecting 90% in a month of what can go out, 90% would go out. I mean, there's been considerable discussion about what they could do. But the idea somehow that whatever the number was then, probably 27 million, 50 million today, 50 million people opening up a check that's 10% less than it was last month is not something our Congress is going to do, I can assure you. And that's the real risk. There are people in serious policy people, including some economists in Washington, arguing that we should let this whole thing lie fallow. Social Security I'm talking about right now. We should let this lie fallow until 2030. Because in 2030, we're going to be within 4 years of looking at a 25% benefit cut, and there is no congressman going to dare to cut benefits by 25% in a 4-year context. If you want to see what the implications of that might be for a politician, go back and look at what happened in 1982 when Ronald Reagan introduced proposed legislative changes to Social Security because he was facing a budget deficit after the 1981 tax cut. He was going to reduce benefits for somebody retiring at age 62 from 80% of a full benefit to 55% within less than a year. This was going to take effect. He was going to have a similar effect on benefits for the disabled. Bob Dole introduced the legislation in the Senate responding to that proposal, repudiating that proposal. Bob Dole, the Senate Republican leader, introduced the legislation that passed 96-0, repudiating Ronald Reagan's proposals. So that's the crisis we face. How do we respond to that? It's not an economic issue.
So I think that, as we saw by the way that Congress recently handled the fiscal cliff issue, we are increasingly living in a world where nothing gets done until the very last minute, where the very last minute is defined by some kind of crisis. I agree with you, and I think it's problematic with the way we handle things in this country right now. I do think that there is a pretty large public relations cost to Social Security in not fixing it earlier, and I also think there's uncertainty that introduces into individuals' lives who are trying to plan for their own retirement, and I think that it is important, and I'm not sure how to deal with the politics because I'm not a political scientist, but I do think that it is important to figure out ways to legislate now. And I agree with John that legislating now for the future is one way potentially around that. Not saying it's going to change immediately, but you're going to do something now, legislate something now that's going to take effect a number of years from now.
This booklet that I'm writing called Efficient Retirement Design, I basically say in it, if you're 55 or over, read this, it might tell you what to do. If you're younger than 55, I have no idea what Social Security is going to look like. I can't give you any advice.
But your comments sort of highlight another interesting example that I find in the state and local space, which is that some state and local governments have declared, that their pension systems are creating a crisis on the grounds that some percentage of revenues, in the case of Rhode Island, it was around 20% of general revenues. In the case of San Jose, California, also around 20% of general revenues were going towards pension contributions, and this was an unsustainable thing. Now, those places were no worse off than Illinois when you measure the liabilities. In fact, Illinois is probably worse off than both those places. But Illinois had written its own rules so that it didn't have to be contributing that amount. So in a sense, we're also dealing with a problem of things don't get done until there's a crisis, and in some places, in some areas of government, the crises are not built in yet, and others they may be built in and coming sooner.
No, I agree with that. I mean, the timing of the crisis is endogenous. It's a decision because the accounting rules that you use to measure this thing kind of determine when you hit that. In some cases. Now, in the state and local context, Lois Scott, who's the CFO in Chicago, said that in the Chicago public school system right now, it's even worse than the state of Illinois as a whole. within, I don't remember exactly how many years it was, but within a few years, the pension cost for teachers in Chicago schools could consume 40% of the dedicated revenue for education in Chicago. Now, that clearly qualifies as a crisis. I don't exactly know how they're going to get out of it, because in the state of Illinois, we have this non-impairment clause, and no one knows how this is going to resolve. I was talking to one of my colleagues, Alan Boschman, earlier before this session started about we really don't know what it means when you have a constitutional guarantee and you simply don't have the money to pay. Something has to give. We don't have a mechanism in place for bankruptcy right now, and no, it's not happened before. No one really knows how that's going to play out. The only other economic point I wanted to make goes back to what Steve was saying about the uncertainty that gets created. Larry Summers had a paper in, I think it was like 1989, in the AEA Papers and Proceedings, pointing out it was the simple economics of mandated benefits, where he talked about when there's a tight linkage between the tax that you're paying and the benefit that you're getting back, there's no deadweight loss from taxation, because essentially in present value you're getting that dollar back at some future state. One of the things that drives a wedge in there that creates a deadweight loss is when there's uncertainty about whether you're really going to get that benefit back. And we've done that at Social Security, we've done that at the state level, and so forth. I actually been telling people in Illinois, we've created the worst possible situation, which is there's a guarantee of the benefits, so the state will probably have to pay them. But the participants in the system don't believe they're actually going to get their benefits, and therefore are not valuing them fully, and therefore are demanding compensation in other ways. And so the state has actually made the financial crisis of this worse, because they're not even getting full credit for the benefits that they're going to have to pay. And so somehow we are going to have to find our way out of this. But that's the $64 trillion question.
Questions from the floor? Microphone, please.
And by the way, I should note while he's coming to the microphone that Sil, who had to leave early, has another book out this year, and it was just awarded the Samuelson Award, and he's heading to the reception for that. So it wasn't that he was offended by our responses.
Going forward, what do you see the role of municipal bond insurers is?
Municipal bond insurers. Yeah. That's a good
Well,
one.
I think one of the big questions here is what is the relative priority that pension claims have relative to municipal bonds? And I can see, this is where I think that a lot of heterogeneity could come into play. The state of Rhode Island passed a law recently that said that for the municipalities, so for the cities in Rhode Island, that pensions would be junior to municipal bond claims. And, you look at that and you say, well, okay, if there are going to be problems with municipal bonds in Rhode Island, it's going to be about whatever claims those municipal bonds are backed by. It's not going to be about pensions. Other places you could imagine, California a few years ago was issuing IOUs. You could imagine some states, maybe Illinois being one of them, at some point running into a situation where, municipal bond insurance would pay off and could hurt municipal insurers. But I think we really, except in the cases, so I don't think the law that was passed in Rhode Island could be passed in Illinois. But I think we're probably going to find out, and that's a lot of uncertainty there.
So I'm Dan Bergstresser. I don't want to be a troublemaker, but I'm impressed by something. I'm impressed that you haven't spent more time talking about health and by the cost of the health promises that we've made through Medicare, the state and local plans. It seems to be a big part. When I get anxious about the future, the cost of health is one of the things that makes me anxious. So was that a pact that you made not to talk about it, or what?
You didn't think that covering Social Security, PBGC, public and private plans was enough for 2 hours?
No pack. But let me just say one thing, these guys will check whether I'm right. I might be even wrong on this. But this is an unintended consequence of the Affordable Care Act. So most state workers have retiree health. And that's one of the advantages of working for the public sector is you have a very good pension plan, you have retiree health, this great plan. So now, until the Affordable Care Act, if you're in the private sector and you retire early, you typically don't have retiree health, and you're trying to, in the individual purchase market, it's not good. So now we have the Affordable Care Act, and if you retire early, you can get your health through the state exchange. And actually, if you're retired, it's likely to be subsidized because your income's not that high. So suddenly the advantage of working in the state sector or the public sector is not that great because you get retiree health if you work in the public sector, but you get exchange health if you work in the private sector. So I actually think this is going to drive state and local wages up. Right? The compensation of the alternative has improved. And so I don't think anybody's really concentrated on that. But the advantage of working in the state sector has been reduced because everybody's got a form of retiree health under the Affordable Care Act.
Well, it's the wedge. It may drive down, it may change the wedge, but
Right.
it doesn't, you don't know which way it's going to go. It could be that private sector wages go down and state and local stay the same. Right?
Could be,
So it's
that's
not-
right.
So, but it could introduce.
All I was saying is there'll be a general equilibrium effect on wages.
Right. Let me just give an example of how messy this can get. So in the state of Illinois, and really anywhere, even where they have these strong protections of retirement benefits, they don't apply to the retiree health. So states are free to basically get rid of those tomorrow. Now, politically, that's a very difficult thing to do. So here's the kind of twisted reform options that get put on the table. So Governor Quinn last year said, all right, if you want to keep your health insurance, you have to give up your COLA, you have to do all this other, basically you have to voluntarily accept a reduction in your pension, and then we'll let you keep your retiree health. If you don't want to keep your retiree health, then we'll let you keep your pension as it is. And because that was considered a voluntary choice, he had lawyers basically telling him that this might actually get by the constitutional thing. Now, I'm not sure that's clear, because to me it's a little bit like, I steal your watch, and then I say, I'll give you your watch back if you give me your wallet, but I've given you a choice. Right? But we may actually have a reform like that in place, and we'll see if that works. But I think at the state and local level, Josh would know better than I, because he's writing a paper I'm supposed to discuss later this year on this topic of just how big those liabilities are. But there's almost no pre-funding. Right? I mean, the health benefits have not been pre-funded at all. So if we think the pension funding situation is bad, it's even worse for health. The difference is that they're much less constrained on what they can do about it because they can eliminate the benefits.
That was why the rest splits. Like why the rest was.
Oh, absolutely. Yeah, I mean, it doesn't get rid of the health care risk. It just means the individual workers are going to bear it, and then that can have implications for overall compensation levels elsewhere.
Yeah, in the California municipal bankruptcies, there has been cutting of retiree health benefits where there wasn't cutting of pension benefits. So, Vallejo being an example. And I think we generally think of this health piece as being junior, but also potentially very large. So I think the Pew Foundation, which just adds up the reports, they found, in addition to the $750 billion of pension liabilities using expected return discounting, they found another $650 billion of retiree health liabilities using a similar kind of discounting, although it's even a bit stranger because in the retiree health, if you do choose to fund, and some entities have chosen to fund, like LA County, for example, has chosen to fund. If you do choose to fund, you get to assume a rate of return on those funds. So the more you choose to fund, actually the lower the liability appears to be. And this is backwards from the perspective of economic intuition, because the more you choose to fund this junior liability, the less you would ultimately be able to abrogate it in the case of a crisis. If it were totally unfunded, you would have more of an ability to abrogate it in the case of a crisis. But the rules say, well, you're going to account for the unfunded thing using a 4% discount rate and the funded thing using an 8% discount rate. However, that may provide incentives. What that does is that might provide incentives to actually fund the retiree health benefits. So those are some of the issues that we're trying to explore in some ongoing work, as well as just, presumably the employees, they realize that these retiree health benefits are at risk. They may be getting some kind of wage premium in response for that. and sort of on the other side of that. And the question is, if that's going on, what is the optimal funding strategy? What the welfare maximizing funding strategy for these junior benefits? Please.
This is Ashraf here, and my question is with regards to asset market. We say that, okay, whatever assumption, required rate of return assumption we use for any of these funds, the asset market has to generate the return. I'm more interested in what is your thought of the technology that we have of transferring today's wealth to future wealth. Okay, if that technology doesn't work, we have seen that the market failed. Regulation, we thought there would be substantial regulatory changes to regulate the market. It did not take place. So if the market doesn't function properly, it doesn't matter what assumption we use, low or high, market will not deliver in terms of return. So what do you think would be the implication for the pension fund performance, be it public or private, given if asset markets do not perform the way we expect it to be? And is there any proposal from the policy side to at least ensure that there is some level of reliability in the performance of asset markets? Thank you.
What's the question? What's the expected rate of return?
I think that, so my understanding of the question is, what happens if these expected returns are not met? I think the way that we think about it in finance is, if you're targeting an expected return, then that means you're taking on a distribution of possible outcomes. And so at least the way I've been thinking about this is, all right, if they're targeting an 8% expected return, maybe when safe securities yielded, 5%, 8% could have been closer to the median. The median of the distribution. Now that they yield 0%, and we kind of think about the risk-neutral expected return on all assets as being equal to the risk-free rate, they yield 0%. 8% is sort of much farther up in the distribution.
Yeah, I mean, one of the issues is, who really bears the risk of the performance of those portfolios backing the state pension plans? Is it the taxpayers? Or is it the participants? So I think at first glance, it's the taxpayers. So the taxpayers have a liability, and they're basically gambling with a risky portfolio to meet that liability. And if the gamble doesn't pay off, I think the taxpayers are, first and foremost, they're the ones that bear the brunt of the shortfall. I also think that these 8% numbers, I mean, I don't even think those are the expected returns. Those are above the expected returns. These portfolios are partly bonds. So they got 30, 40% earning 2 or 3%. How can you get to 8 after expenses?
You lever up the rest.
Lever up the rest, yeah.
Hi, John Dolan, and I came from the mortgage track to hear this presentation because I think the two are related. And just on that last one comment related, Jeff took the thunder out of my first question related to the rating agencies. I think that's your agent who might be able to kind of force something to happen. But getting back to your point, are the taxpayers the ones on the hook? I would think more likely, given the Depardieu example, it's the homeowners who are on the risk rather than the taxpayers, because the taxpayers can, as you said in one of your earlier examples, pick up and go, particularly in the small states. So I'm very curious as to the impact of public pension plan problems on real estate values, and particularly, I live in Chicago, I live in Illinois, and that's too bad.
I think that's a good point.
I think Marty Feldstein had a paper, I believe, on this 30 years or more ago that looked at unfunded liabilities and the extent to which they were capitalized. And I haven't seen that literature updated in a very long time. I may have missed some papers, but if there's any young scholars in the audience looking for something, there may be something to that. But I think you're raising a really good point, which is it may be we always say that the inelastic actors bear the tax burdens, right? And it's going to be the inelastic factors like land and buildings and so forth that may ultimately end up bearing this in the long run, given the mobility of labor and the mobility of financial capital. I think that's a great point.
It is a good point.
Cyrus Ramazani. I was a student in the early 80s, coming from a developing country that lacked Social Security. And of course, learning about Social Security system here, hear the stories that in developing countries, the Social Security system is having a lot of children. And I've taken that hedging position myself in recent years, looking at retirement shortly. But certainly, the point I was going to raise is that the recipients certainly and future recipients have been taking notice. The early warnings came in the 80s, and there has been, in my view, some hedging behavior among future retirees in terms of how they form their resources. Has there been much research done, or is this just a conjecture that Social Security was not always a given system? It wasn't created in 1776. It came to be, and then people enjoyed it for a while, and then they realized that it's too good to last. My question was, has there been any research on actually what hedging behavior people have taken, given that since 1980s we have learned that the system may not be there, although it's not really clear what the calamity is, what the default would be like if it occurs. And then secondly, whether we could begin to think of policies that would in fact encourage that kind of hedging activities for people to not think of Social Security as their
These guys are going to answer, but it's a good point. I mean, all the surveys say that the young people don't have much faith in Social Security, so I think in some sense the question is, are young people saving enough and planning to get by without it?
I think that's exactly the right question, and I always repeat, just for fun, in the course that I teach, I always repeat that survey where you ask at the beginning of the semester, and you ask people about whether they believe in UFOs and whether they believe they'll get Social Security, and you always find they are more likely to believe in UFOs.
The scary part about that survey is that a lot of people believe in UFOs.
Yeah, it's true, actually. It's quite high. But to John's point, I mean, the most natural response to that, especially among young people, is to save more. But we certainly have not seen over the last 3 decades a trend toward higher savings rates, at least if we compare current cohorts to the same age, to the older cohorts at that age. So if they're doing it, it's not clear where it's showing up. It's not showing up in savings behavior. It's not showing up in annuitization through other avenues. We've seen a decline in that. So all the things that I sort of think about, another one would be to work longer, but we really haven't, for most of the 20th century, we saw a decline in average retirement age. Now that has leveled off, I think, in the late 80s, early 90s, and has remained relatively stable over that period. So I don't see any of the behavior that would suggest that people are actually hedging, but there may be some I'm not thinking of.
People are working a little bit longer than they did 20 years ago. So when they retire, they're further from birth. They're also further from death.
Right.
So retirement lengths have not shortened, they've lengthened.
I think the savings question also depends a little bit on the discussion we were having before about inflation. I mean, if you think inflation is not an issue, or that there might be deflation, then savings becomes an easier proposition. If you just feel that your savings are going to get eroded anyway, or you need to invest in inflation-linked assets to get there. I see, some young people may think about inflation in different ways than others. So I think that's another. Other questions from the floor, please.
My name is Tomas Dvorak from Union College. You mentioned that markets for annuities are not very well developed. Why is that? What are the market failures that make it hard to even buy inflation-indexed annuity?
There's a whole literature on this, and we can all think about, and most of this has been documented. So we know there's adverse selection in the private annuity markets, that the adverse selection component generates about a 10% load on top of anything else. So roughly speaking, you get about 10 cents on the dollar less back because of the mortality experience of the annuitants looking different than otherwise. But that only, the price elasticity demand for annuities isn't so high. That can't explain it all. People have looked at, within couple risk sharing, option value of delaying. I mean, there are dozens of papers on this. At the end of the day, for a long time, specifically on the issue of your question about why inflation-indexed annuities don't exist. For a long time, until the late 90s, people said it's because the insurance companies didn't have inflation-indexed bonds with which to underwrite them. So then the Treasury introduced inflation-indexed bonds, and almost no one introduced inflation-indexed annuities. There's a little bit of a demand-side issue that, as Steve pointed out, despite what the survey says, if there's one thing people like less than an annuity, it's an inflation-indexed annuity. People just don't want to buy them. But second of all, what the insurers will tell you, and I don't really buy this because I think there's ways you could do this synthetically, is they say, well, look, there are inflation-indexed government bonds, but it's not a very liquid market, and it's only inflation-indexed bond. I mean, it's only government bonds, and what they're usually doing to underwrite nominal annuities is buying corporates and taking on a little bit of credit risk and so forth, and they feel they can't do that very efficiently in the index market. I think there are ways you could, but I really think it's more of a demand side issue. So then you have to ask the question, what's happening on the demand side? And in the last 3 or 4 years, there's started to come out now a number of behavioral papers that suggest that we've conditioned people to think about wealth accumulation, and in a wealth accumulation framework, annuities look like they're illiquid and have low returns. There's papers now about complexity and the role it plays, and this is not a decision that people can learn from experience and so forth. So I actually think that there are both demand and supply side market imperfections, and a number of them, and that unfortunately fixing any one of them, it's kind of one of these problems of the second best. If there's 10 market failures and you fix these 2 or these 3, you may have no effect, you may make things worse. So if you want more, I'd be happy to
certainly the irreversibility, that is, if you put your life savings in an annuity, you can't change your mind the next day and say, no, I know I bought it, I now want to sell it. It's very irreversible. People are very hesitant to put their life savings into this irreversible product. Secondly, I think people are just not used to negative interest rates. I mean, have you looked at TIPS rates lately? 10-year rates are minus 75 basis points. 20-year rates are 0. So, I mean, it's a real shocker when you look at, wow, I'm going to give my money away for 20 years and just get back what I gave, no real payment at all. So, buying these bonds, whether you're buying them in annuity form or you're buying them in just bond form, boy, it's sobering how low interest rates are. What a contrast between these assumed, I know they're nominal, but these 8% discount rates, and if you look at these TIPS rates at 0 for 20 years, wow, it takes a little getting used to giving your money away for 0.
In the internet surveys that we've done on annuity demand, a couple things that we found that are relevant to your question. One is that the 2 factors that people identified as the largest barriers to annuitization were the counterparty risk, the concern, however slight, that either the company in a DB setting or the insurance company might not be able to pay out in the future, even if it's a small risk. That looms heavily when you're thinking about what you're going to be living on when you're 90. And also the lack of flexibility and control that are present in annuities, as John alluded to. So those were 2 factors that I think are important, and I think there could be additional work on the product design front to improve those. On the inflation index front, we asked people whether they had this, as I mentioned, we asked people whether they had a demand for inflation index annuities, and we saw a fairly reasonable demand for that. And then we did an intervention, a different treatment, where we described to people what inflation means, how high it might be, and what that does to the purchasing power of your money over time. And so for the control group, we didn't include that sentence or 2. And for the treatment group, we did include that sentence or 2. And we saw a dramatic increase in the take-up of inflation index annuities simply from explaining to people in a couple sentences what inflation does to the purchasing power of their money. So that suggests that there might be a role for better communications materials around explaining inflation to people.
Excellent. Okay, yeah, let's take one more question. And it looks like there are a couple. We'll take 2 more. We'll take 2 more, and then we'll wrap it up.
Hi, my name is Jia Chen. I just graduated from Ohio State and starting a job in Peking University in Beijing, China. So as China is going through a lot of changes, And recently going through a heated debate about designing or developing a pension system. I found your discussions very interesting. So my question may be very general. Basically, is there any good example where the pension system has worked well in terms of funding situation around the globe?
I'm going to say it because Jeff probably won't, but because he would view it as being conflicted. But maybe you could comment on whether TIAA-CREF would satisfy that criteria. And maybe someone else, maybe Steve or John, who is not affiliated, could say something about that.
Well, I think TIAA-CREF's done a fantastic job. That actually is. I mean, it is a terrific. It's been 90 years of university faculty that have benefited from that. When I look at public systems around the world, there are some countries. We were just whispering back and forth about Australia that has a superannuation fund. I think Julie in the back could probably tell us more about it. That I think have done at least a pretty decent job of funding. I know a little bit less about how the payouts are done and so forth. I don't know. I mean, part of the issue. I've been to Beijing a couple of times to talk about pension stuff, and their situation is very, very different from the U.S. Right? If you take the official statistics at face value, they certainly don't have a savings problem. Right? And so some might argue from a macro perspective that in that kind of a world, they might almost be saving too much, and maybe a pay-as-you-go system is actually welfare enhancing in the short run. And so I think while it is fruitful to look around the world, I think it's really important to adapt it for the kind of the macro situation that you face. So I'm a little hesitant to kind of suggest a particular model to impose on that.
This is not in response to the question, but I just something flashed in front of me, which is Jeff said he's involved with TIAA-CREF. I should say that I'm involved with Financial Engines, the company that Bill Sharp started. I don't think it's affected anything I've said, but I just wanted you to know that I am associated with Financial Engines.
I just wanted to add on systems around the world. I mean, to the extent that one can find successful occupational DB systems. I mean, the Netherlands would seem to have the most robust system. They basically had in place a regime where they've been able to implement conditional indexation, so you get a nominal benefit if the returns are sufficient or insufficient to provide a real benefit, but you get a real benefit if returns are high enough. They've been able to implement collective defined contribution plans. I think one thing that often gets lost, when I think about what's a design that going forward I would imagine would be great to introduce, at least in part, to the U.S. Public sector system. It involves some element of conditional indexation or of a collective defined contribution plan. So a plan where to some extent employees in California would own shares in CalPERS and would get a pension when they retired based on the value of those shares, as opposed to having a purely state guaranteed benefit. To what extent you want to provide state guarantees, to what extent you want to do pay as you go, that depends on optimal savings rates and other things. So last question.
I'm Mahdi Rastad. Related to the politics of reform that Jeff raised, my question is about the secondary market for this public pension funds basic benefits. Basically. So if I'm a state employee, is there any secondary market that I can go there and basically sell the stream of benefits that I'm going to earn over the years and then just cash out for some lump sum? I mean, this, for one thing, would change the audience or the target group of those who are the beneficiary of those benefits, and then probably makes the political economy of the reform easier. And then for the other thing, it actually adds more clarity to the market in a sense that market can give you what is the actual spread or the default risk for those benefits.
Yeah, it's an interesting question. To the best of my understanding, there is not currently a market for that. There are some companies that will buy back fixed annuity streams, but like J.G. Wentworth, you know, have you ever heard their ads?
Extreme.
They will not, I'm not endorsing them in any way, just, you know, that jingle sticks in my head. So they will buy back annuity streams. However, I was interested in this question and called them up once and talked to them, and they said they will not buy back a life contingent annuity stream. They will only buy back a fixed stream. So if you know you're going to, if you have a fixed obligation, you're going to get it for a certain number of years, like a period certain kind of thing, they will buy that back, but they will not buy a life contingent stream back from you. You know, there were similar markets that started to evolve in the life settlements market, which is the opposite side of buying back a lifetime income stream, where that has been a fairly controversial market for a variety of reasons. But I have not seen anything in terms of marketing and selling these things. I think it's an interesting possibility, and also interesting that one could develop a market where you could have an aggregate pool of these things traded. And in some work that John Giannakopoulos and I have done, we've talked about the possibility of developing that market for pools of these things rather than one, not an individual one, but a pool of an income stream.
I was going to say, I think we learned something about Steve's sleeping habits, because the only time those annuity buyback ads are on are bad cable stations at like 3 a.m. But I think I know for Social Security it's illegal, and I believe in a lot of state plans it is as well. I can't say that with absolute authority, but I think there are legal restrictions against selling out, basically even using pensions as collateral on a loan. So that may be why the market just doesn't exist. I mean, for Social Security, I think the idea was it wasn't necessarily a good economic reason. It was just this notion that this was meant to be. I think what they were trying to avoid is you sell back your Social Security and then somehow you find your way of, you know, still falling back and relying on state assistance in some other way. So maybe that is a good economic reason. You're trying to combat that form of moral hazard. But I think it's also just sort of a more of a philosophical view that this is meant to be your retirement income, and we don't want you to, you know, use it for other purposes.
I mean, it's interesting that for the public employee benefits, public employee groups have been pretty adamant about maintaining these expected return assumptions, but all of a sudden, once you start talking about actually buying out their benefits, I think they might be in favor of lower discount rates.
I mean, one advantage of such a market is if you could create a market where pools of these annuity streams were packaged and sold, you would develop market prices, and that would go a long way toward helping in the discussion of what's the right discount rate to use in valuing these liabilities. So it's the lack of a market and the lack of a publicly traded market that worsens this problem, I think. So I think it's an interesting avenue to explore.
Okay, well, with that, I'm going to have to call an end to this panel. I think you're seeing 4 people here who could probably just sit here all night and talk about this stuff without getting too bored, but there are other things that need to be accomplished. We have to move on to other sessions, interviews, cocktail parties, and the like. So thanks to the audience for your great participation. Thank you very much to my panelists here who came today at my request, and very much appreciate their having done so and your attention and participation.